In the global financial system, sometimes a quiet comment made in a distant room can shake the world louder than any earthquake. And this week, that tremor began in Tokyo. For decades, Japan had been the silent outlier of advanced economies, while the United States, Europe, and many emerging nations raised interest rates aggressively. Japan held on to its near-zero rates, refusing to move with the global tide. It was a strategy that defined its identity in the modern financial era. But this time, something changed. Something subtle, yet powerful enough to wake every major trader and analyst across the world. The shock started with a single statement from the governor of the Bank of Japan. He commented that the central bank would be reviewing the pros and cons of lifting interest rates in its upcoming meeting. Just a simple sentence. No promises, no formal announcement, just a signal. But it was enough. Within seconds, Japan's bond market reacted as if someone had pulled a fire alarm. The 2-year Japanese government bond yield that almost always responds instantly to policy expectations snapped upward. It broke above 1% for the first time since 2008. The 10-year yield followed, rising near 1.9%, a level not seen in years. Both moves pointed in the same direction. Investors were preparing for something Japan had not done in decades, a real shift in monetary policy. But the true story wasn't the movement itself. It was the speed of the reaction. The world didn't wait. Global markets did not pause. Almost immediately, the financial shockwave spread outside Japan. Yields in Europe began to climb. Bond markets in the United States jolted upward. Traders suddenly pulled back on expectations for deep rate cuts in 2026, adjusting their forecasts in real time. The U.S. 10-year Treasury, one of the most important interest rates in the world, jumped above 4% again. The 2-year Treasury rose to 3.5%. And all of this happened because of a subtle shift in tone from Tokyo. The global picture became more fascinating. Why was Japan's move so powerful? Why did a single central bank, after years of silence, suddenly cause such chaos across continents? The answer lies in Japan's role as one of the world's biggest buyers of foreign government bonds. Japanese investors hold massive amounts of U.S. treasuries and European debt. So when yields in Japan finally begin to offer attractive returns, investors are likely to bring their capital back home. This means fewer buyers for US and European bonds at a time when both regions are issuing enormous amounts of debt, a dangerous combination that increases borrowing costs everywhere. Analysts described it perfectly. A butterfly flaps its wings in Tokyo, and the wind hits Washington and London seconds later. As the Tokyo shockwave spread, Europe and the United States felt it almost instantly. European bond yields spiked as investors recalculated risk and returns in real time. The ripple effect was clear. What started as a subtle signal in Japan became a global tremor. In the United States, the Treasury market reacted with remarkable speed. The 10-year yield jumped above 4%, while the 2-year climbed to 3.5%. Traders quickly abandoned expectations for multiple rate cuts in 2026, slashing predictions from 6 or 7 cuts down to just 2 or 3. Financial models were being rewritten within hours. Why did this happen so fast? The answer is Japan's unique position in the global financial system. Japanese pension funds, insurance companies, and banks collectively hold trillions in foreign government bonds. Much of this exposure is in U.S. treasuries and European sovereign debt. When domestic yields rise in Japan, these investors face a choice: continue holding foreign bonds or repatriate capital to earn better returns at home. And as history shows, many will choose the latter. This means less foreign capital supporting U.S. and European debt markets, forcing governments to borrow at higher rates. It's a chain reaction that moves quickly. One shift in Tokyo, one adjustment in bond yields, and suddenly liquidity across the world tightens. The yen, too, responded violently. After months of weakness, the currency surged nearly 1% against the dollar in a single session. This was not merely a technical move. It was the unwinding of the so-called carry trade, where investors borrow in low-yield currencies like the yen to invest in higher-yielding assets abroad. A stronger yen forces traders to reverse these positions, putting further pressure on global markets. Equity markets did not escape unscathed. On Wall Street, technology shares led the pullback as investors sold riskier assets. Both the Nasdaq and S&P 500 slipped into the red. Cryptocurrency markets, known for volatility, also reacted. Bitcoin fell by 7% on the day, erasing more than 20% of its value over the past month. Interestingly, high-growth stocks and cryptocurrencies have become tightly correlated in recent months, meaning when one falls, the other often follows. This interconnectedness amplifies the impact of any global financial tremor. It shows how a single policy shift in Tokyo can influence everything from government bonds to tech stocks and digital currencies. The key takeaway is clear. Financial markets are deeply interconnected, and central bank signals in one country can have immediate and far-reaching consequences. Investors, policymakers, and everyday participants must remain alert, because liquidity can tighten faster than expected, and rates can shift overnight. While Tokyo set off the first shockwave, the United States Federal Reserve was facing its own set of challenges. Investors had been anticipating rate cuts in December, hoping for relief from a year of tightening. But the sudden shift in Japan changed everything. Markets quickly adjusted expectations. The probability of multiple rate cuts in 2026 dropped sharply. Now, traders were pricing in only a few cuts, rather than the 6 or 7 originally predicted. The potential replacement of the Fed chair added another layer of uncertainty, leaving markets in a delicate balancing act. The US dollar, once the unshakable pillar of the global financial system, began to show signs of vulnerability. A fading rate advantage combined with political and leadership uncertainty caused its value to dip. It suffered its worst week in months, reflecting concerns that the US could lose some of its financial dominance if global investors shifted capital elsewhere. Meanwhile, the euro and the British pound gained strength against the dollar. European investors, watching the US bond market adjust and Japan's yields rise, found new opportunities in their local currencies. Currency volatility was on the rise, creating risk but also opportunity for traders and multinational businesses. The impact was not limited to traditional financial markets. Equity markets, particularly tech-heavy indexes like the Nasdaq, felt the immediate pressure. Investors sold riskier positions, causing a pullback across the board. High-growth companies, already under scrutiny due to rising borrowing costs, experienced sharper declines. Cryptocurrency markets, often seen as separate from traditional finance, were pulled into the turbulence. Bitcoin dropped 7% on the day, continuing a month-long slide that erased over 20% of its value. The correlation between high-growth equities and crypto had intensified, meaning that as tech stocks fell, so did digital currencies. This unusual link highlighted the fragility of risk sentiment during periods of global uncertainty. At the core of these market reactions is the interplay between central banks. The Bank of Japan's potential shift in policy, combined with the US Fed's actions and uncertainty over future leadership, created a complex, rapidly evolving scenario. Each decision reverberates across currencies, equities, bonds, and commodities. Global investors are now faced with tough choices. Do they continue to hold US Treasuries in the face of rising Japanese yields? Do they rebalance portfolios toward stronger currencies or safer assets? Every move is interconnected, and the margin for error is shrinking. The lesson is clear. Even subtle policy signals from a central bank can create massive shifts. When Japan moves, the dollar, global equities, and cryptocurrencies respond almost immediately. And with multiple central banks poised to act differently in the coming months, the potential for further turbulence is significant. December is no longer just another month on the economic calendar. This December will decide the direction of 2026 and possibly the next decade. Because for the first time in almost 40 years, the Bank of Japan and the US Federal Reserve are preparing to make decisions that could collide or align in ways that shake the entire world. Tokyo is under intense pressure. After decades of ultra-easy monetary policy, after keeping rates near zero while the world tightened aggressively, the Bank of Japan is signaling that it may finally pull the plug. If Japan truly ends its era of cheap money, global markets will feel it instantly. But the Bank of Japan is not alone in the spotlight. All eyes are also on the US Federal Reserve. Investors want clarity. They want confirmation. They want to know whether the Fed will actually deliver the rate cut they hinted at earlier in the year or whether inflation worries and political uncertainty will force them to delay. These two decisions, Tokyo's and Washington's, are now intertwined. If Japan raises rates while the Fed cuts theirs, the global currency map could flip upside down. The yen could surge. The dollar could weaken further, and trillions of dollars could shift as global investors rebalance and repatriate money back to Japan. But this isn't just about currencies. This is about real life. Because when global liquidity tightens, everyday people feel it before anyone else. Mortgage rates stay high. Car loans become more expensive. Credit card interest rises. Small businesses struggle to borrow. Governments with massive debts, especially in the US and Europe, suddenly face higher financial pressure, forcing them into tough decisions that affect millions. And then there is China. Its economic slowdown is creating regional pressure that Japan can't ignore. Weak demand, property instability, and declining exports are pushing Japan into a corner where it must choose. Stay ultra loose and risk a weaker yen, or tighten and risk slowing domestic recovery. Every direction comes with consequences. Meanwhile, financial markets are on edge. Traders, analysts, and investors know that the wrong move or even the wrong phrase from a central bank governor can trigger massive volatility. Because the truth is simple: when Japan moves, the world reacts. This December, two world powers will make decisions that could define interest rates, currency strength, and global financial stability for years to come, whatever happens next. We are witnessing a rare economic moment, one that demands attention, one that could reshape everything. Stay alert, stay informed, and subscribe so you don't miss what happens when these decisions finally hit the markets. Because December isn't just the end of the year, it's the beginning of a new global chapter.